This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 14, 2026, and this is the New York pre-market. Now, let's get into it. IBM has vanished 21% in pre-market trading, shattering the enterprise AI narrative and dragging the Nasdaq 100 down nearly 2%. As of 16:34 Eastern Time, the S&P 500 is clinging to $749.17, while the VIX remains deceptively quiet at 15.3. We are witnessing a sector-specific rupture that is rewriting the rules for growth valuations right now. Looking ahead, the market's attention turns to the financial sector's quarterly results. Today features earnings from J.P. Morgan Chase estimating $5.52 per share, Goldman Sachs targeting $14.47, Bank of America at $1.13, Wells Fargo at $1.73, and Citigroup at $2.72. Tomorrow, Aluminum Corp of America expects $2.09. And looming later in the week, we approach the monthly options expiration cycle on Friday, July 17th, which typically amplifies gamma-driven volatility in these already fragile levels.
With the tech sector bleeding out, those financial prints are no longer just corporate updates. They are the sole remaining pillar supporting the broader equity index. The question isn't whether tech can recover, but whether JPM and Goldman can prove that credit demand hasn't evaporated alongside software orders.
Here is the snapshot as of 16:34. The S&P 500 SPY is at $749.17, down 0.77%, having failed to hold the $750 psychological handle. The Nasdaq 100 QQQ is at $711.74, shedding 1.9% as it tests the lower bound of its recent consolidation. The Dow Diamonds holds at $524.47, down a mere 0.25%, showing remarkable relative strength. Meanwhile, the Russell 2000, IWM, is at $293.48, down 0.85%, signaling that small caps are struggling to find a bid even among the defensive rotations. The standout mover today is clearly the Technology Select Sector SPDR, the technology sector, at $181.28, plummeting 2.42%, while the energy sector, surges 3.1% to $56.74. Let's break down the catalyst driving this chaos. IBM has gapped down 21.1% to $229.09 following a second quarter revenue miss. This wasn't a minor stumble, it was a structural failure of the AI monetization thesis. Salesforce, CRM, has followed suit, dropping 5.7% to $161.43, while ServiceNow has fallen 7.4%. The headline narrative is describing this as a devastating blow to software valuations. CIPHER, walk us through the fundamentals of this collapse. Is this a one-off error or a trend?
It is a fundamental repricing, not an error. IBM's 21.1% drop to $229.09 reflects a missed revenue target that suggests enterprise clients are suddenly pausing large-scale AI infrastructure commitments. When you look at the contagion, Salesforce down 5.7% to $161.43, and now down 7.4% to $103.01, you see that the rejection is across the entire stack. This isn't just IBM, it's a broad correction in discretionary software spend. The valuation gap is widening because the earnings growth assumed in the technology sector at $181.28 is simply no longer present in the near-term guidance.
And that's why the sentiment is so fractured. Look at the divergence. IBM and CRM are experiencing severe implied negative sentiment purely through price action, but contrast that with Goldman Sachs, which carries a bullish sentiment score of plus 0.38, or Meta at plus 0.33. The market isn't panicking broadly. It is surgically excising tech. The VIX is sitting at 15.3, which tells me the general public is asleep at the wheel. But the specific sentiment around AI/software has turned violently bearish instantly.
I need to correct the assumption that this is just sentiment. This is a technical breakdown. SPY closed at $749.17, which is below the July 13 low of $748. No, it closed slightly above but effectively at support. However, QQQ at $711.74 is precariously positioned just $1.66 above the July 13 low of $710.08. Once QQQ breaches $710, the path clears to $700.91, which was the July 8 low. That is a significant gap-up zone. The technical structure is screaming distribution, not accumulation. The fact that the technology sector is down 2.42% while the energy sector is up 3.1% confirms this is a sector rotation trade, not a broad market event.
Grid, you're looking at the floor, but you're ignoring the ceiling collapsing. The VIX at 15.3 is a dangerous compliance trap. You have a 21.1% single stock crash in a megacap, and the broad volatility index is barely twitching. That means the fear is trapped inside the tech sector, not diffused. That creates a liquidity vacuum. When IBM drops that hard, it doesn't just hurt IBM. It resets the benchmark for every other AI stock. The safe havens like the energy sector at $56.74 aren't rising because they're good. They're rising because the alternative, long-duration tech, is becoming toxic.
That brings us to the second major pillar of today's move, the defensive rotation. While tech dumps, the energy sector, is up 3.1% to $56.74, and utilities, the utilities sector, are up 0.68% to $45.72. The S&P 500, SPY, is at $749.17, trying to hold ground. But the divergence between the S&P 500 information technology sector and the energy sector is stark. SPECTER, you mentioned the VIX being deceptive. What does that disconnection tell you about the risk profile right now?
It tells us that the market is mispricing tail risk in tech while rewarding inflation hedges. We have a sticky CPI at 3.46% and a 10-year Treasury yield of 4.62% against a 2-year at 4.26%, leaving a flat yield curve of just plus 0.36 pp. High rates crush multiple expansion for unprofitable tech, which is why the technology sector is bleeding at minus 2.42% to $181.28. But the VIX at 15.3 suggests traders think this is a correction. It's not a correction. It's a re-rating. The risk here is that as we approach the July 17th monthly OPEX, gamma exposure could amplify these moves. If SPY falls back below $748, the lack of put protection suggested by the low VIX means we could see accelerated downside velocity in the final hours of trading.
I agree with the velocity concern, but let's look at the specific levels. SPY at $749.17 is hovering right above the $748 support level established yesterday. If that breaks, we target $745. QQQ at $711.74 is testing $710.08. I am watching the volume on that level. If QQQ fails $710.08, we don't just correct, we gap down to $700.91. Meanwhile, look at IWM at $293.48. Small caps are down 0.85%, but they are holding up better than the mega caps in some respects, though the underlying structure is weak. The relative strength failure is real. IWM is lagging SPY's resilience. The money is fleeing growth entirely.
And where is it going? It's going to financials. The financial sector is green at plus 0.65% to $56.07. Why? Because the upcoming earnings from JP Morgan at $5.52 estimates and Goldman Sachs at $14.47 estimates offer concrete cash flow visibility that software lacks. The market is essentially shorting the future AI and longing the present banks/energy. The valuation gap between the technology sector at $181.28 and the energy sector at $56.74 is unsustainable if IBM continues to guide down. This isn't just sentiment, it's a fundamental arbitrage happening in real time.
So, the consensus is that capital is rotating out of the technology sector and into the energy sector and the financial sector. Let's drill down into the specific assets moving the needle. First, IBM. It is down 21.1% to $229.09. Grid. What does the chart say about a megacap this size falling this fast?
At $229.09, IBM has invalidated any recent technical structure. There is no support here, this is free fall. The gap down itself acts as the new resistance. Any bounce back toward $235 or $240 will be met with heavy selling. This is a break-and retest failure on steroids. The momentum indicators are oversold, but in a gap-down scenario. That usually leads to further capitulation rather than relief rallies. It's a pure distribution pattern.
And the sentiment on IBM has gone from neutral to hostile in hours. Compare that to NVDA, which is currently sitting on a neutral sentiment score of plus 0.19. The market is waiting to see if NVIDIA gets dragged down by IBM's gravity. Until NVDA sentiment turns explicitly negative, traders might try to buy the dip in QQQ. But CIPHER, I suspect the fundamental link is stronger than chartists believe.
Absolutely, the link is structural. IBM is an enterprise buyer, NVIDIA is an enterprise seller. If IBM stops spending, the supply chain contracts. The 21.1% drop in IBM validates the fear that AI adoption is slower than priced into NVDA or MSFT. So while NVDA trades neutral, the flow data is showing institutions reducing exposure to the hardware side in anticipation of software side order cuts. It's a preemptive strike on margins.
Let's pivot to the index level that matters most for the broader market, the S&P 500, SPY, at $749.17. It's down 0.77%. Grid is $748 the line in the sand.
$748 is the line. SPY closed at $749.17, which is technically above the July 13 low of $748, but it's razor thin. The 10-day range is $732.09 to $755.42. We are currently at the lower quartile of that range. If $748 breaks, we drop to $745 quickly. The volume profile shows heavy selling pressure entering the close. The index is being weighed down by the megacap tech drag. It's holding only because the financial sector plus 0.65%, and the energy sector plus 3.1% are propping it up artificially. Without the technology sector at $181.28 crashing 2.42%, SPY would be much weaker. This support is fragile.
Fragile is an understatement. It's illusory. The reason SPY is holding $749.17 is because the VIX is at 15.3. Market makers are hedging using options that assume calm. But with IBM gapping down 21%, that calm is gone. The risk is that as we hit the daily close, the disconnect between the VIX and the actual price action causes a sudden unwind of call spreads. If SPY slips below $748, we won't see a slow drift down. We'll see an acceleration because the volatility suppression tools are breaking.
All right, let's look at the other major index. QQQ at $711.74, down 1.9%. This is the pure play on growth and tech. The low of the last session was $710.08. Grid, you've identified this as critical support.
It is the most critical level in the book. QQQ at $711.74 is $1.66 above $710.08. A breach of $710.08 opens the door to $700.91, the July 8 low. That's a $10 gap, given the speed of the IBM sell-off. Hitting $710 feels inevitable unless there is a sudden influx of buying. The RSI on the hourly chart is diving. This is not a healthy pullback, it's a liquidation event. The technical damage done to the QQQ chart today will require days to repair.
And the fundamentals justify the sell-off. You can't argue with a 2.42% sector-wide drop in the technology sector. The earnings estimates for the top 10 holdings in QQQ are being revised down. When the biggest component weights are getting hammered by revenue misses, the index mathematically must fall. QQQ at $711.74 is just finding the bottom of the barrel. The support at $710 is artificial. It's based on past price, not current fundamentals.
Which brings us back to the sentiment trap. Retail traders see down 2% and think buy the dip. Institutional sentiment, however, is fleeing. Look at the put/call ratios for QQQ options. They are spiking in the very same moment the VIX is flat. Institutions are buying puts to hedge against a break of $710. They are not catching a knife, they are insuring against it. So when Grid says $710 is support, the flow data suggests that once it breaks, the floodgates open. We have one more major asset class to discuss, the defensive rotation. The energy sector is up 3.1% to $56.74. Utilities, the utilities sector, are up 0.68% to $45.72. In a risk-off environment, these are the beneficiaries. SPECTER, you've been warning about the flight to quality. How does this rotate work?
It's a classic inflation hedge pivot. With CPI at 3.46% and the Fed funds rate stuck at 3.62%, growth stocks suffer from discount rate expansion. Energy and utilities, however, produce tangible assets with pricing power. The energy sector at $56.74 is rallying because oil and gas prices are firm, and utilities have regulated returns. The 3.1% gain in the energy sector is a direct proxy for investor fear of stagflation. They aren't betting on growth, they are betting on survival. The divergence between the energy sector's green candle and the technology sector's red candle is the most important chart pattern in the market today.
And it's accelerating. Look at the weekly performance. The energy sector is up 6.79% this week. That is not a one-day spike. That is sustained institutional inflow. Money is parking in the energy sector because it's yielding real cash flow while the tech sector burns it. The valuation gap is expanding. The technology sector at $181.28 is expensive relative to earnings growth, which is slowing. The energy sector at $56.74 is cheap relative to historical norms. This rotation isn't temporary. It's structural until inflation data improves.
So we have IBM crushing tech sentiment, QQQ testing $710 technical support, and capital flooding into energy and financials. Let's tie this together. Apex, you're the orchestrator. How do we view this landscape as we head toward the close and the upcoming financial earnings?
We are viewing a market in transition. Grid identified the technical fragility at QQQ $710 and SPY $748, noting that these are lines in the sand. CIPHER confirmed that the fundamental driver is the IBM revenue miss, which has triggered a structural derating of enterprise software, forcing a rotation into financials like JPM and Goldman for yield and stability. Pulse highlighted that while the VIX at 15.3 suggests calm, the sentiment on NVDA and MSFT is neutral to negative, indicating that the buy-the-dip crowd is being outpaced by institutional hedging. SPECTER warned that the VIX complacency is masking tail risk, and if SPY breaks $748, the lack of volatility protection could accelerate the drop. The synthesis is clear. Growth is under attack, defensives are thriving, and financial earnings tomorrow will be the litmus test for whether the market can stabilize or if the rot deepens.
Thank you for joining us on the ShadowQuant Equities edition. To summarize, IBM's 21.1% crash is driving a sector-wide repricing of AI software, dragging QQQ towards $710 support. The S&P 500 is holding at $749.17 only through the strength of energy and financials, which are seeing massive inflows. Volatility remains suppressed at 15.3, but the disconnect between price action and sentiment is widening. Tomorrow, watch JPM and Goldman earnings for signs of credit health, and monitor the $710 level on QQQ for a potential breakdown. Stay sharp. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.